In this video, I'm going to break down the value and debt associated with every single one of my current real estate investments. There are 7 properties in total, so let's dive right in. The first property is the 4-family home that I bought back in January of 2020. This property appraised for $589,000 in March of 2021, and as of December 2021, we owe $437,444.20. That leaves us with a positive net worth of $151,555.80. I don't have any money left in this property, so this equity is pure profit. My plan for this property is to use it as an education fund for my first child. By the time she's 22 years old and potentially done with college, the mortgage will have been paid down to $195,000. At that point, I will refinance the property and pay for her education in cash. If the property value increases by 1% per year over the next 21 years, we should be able to appraise for $726,000. If we refinance at 75% loan to value, we'll be able to put a new loan of $544,500 on that property. After paying off our existing loan of $194,745, our cash out of the deal will be $349,755. Hopefully, that covers the cost of her education. The second property in my portfolio is the 3-family home that I bought back in September of 2020. That property appraised for $320,000 back in September 2021, and we just refinanced into a new loan in the amount of $256,000. That leaves us with a positive net worth of $64,000. I don't have any money left in that property either, so this equity is pure profit as well. I almost sold this property a few months ago before I changed my mind at the last second and decided to refinance into long-term fixed rate debt. And I actually made a video about my decision to sell this property, so if you're interested in watching that, I'll link it at the end of this video. The third asset is a 4-unit mixed-use property that we bought back in March of 2021. We used 100% debt financing on this property for the purchase as well as the rehab, and our total loans currently amount to $360,000. We have yet to request a formal appraisal on this property, but in my opinion, the value should come in at or above $600,000. And if my valuation is correct, we currently have $240,000 of equity sitting in this property. Here's how I got to my valuation. Since this is a commercial property, we have to use net operating income and cap rate to determine value. Net operating income is a function of revenue minus expenses. Our rent roll for this building is $58.62 per month. After accounting for vacancy expense, we expect to collect $56.28 per month. Our fixed and variable expenses come out to roughly $22.90 per month, which leaves us with a net operating income of $33.40 per month or $40,000 per year. Based on various cap rates ranging from 6% to 7.5%, I think this property averages out to a value of $600,000. Since this is a commercial property, we're having trouble finding a decent loan term for a refinance. Right now, the best rate that we can achieve for a 30-year fixed rate is 5.75. If I want a rate in the low to mid 4s, I have to get a commercial loan which has a 5-year payment term and is amortized only over 20 to 25 years. I don't want to deal with refinancing again in 5 years. So if I can't find a 30-year fixed rate loan in the low 4s by the end of Q1 of 2022, we will likely just sell this property and roll the profits into the next deal. I've actually been itching to do a 1031 exchange, so I'm sort of hoping that we don't find that awesome loan. The fourth property in my portfolio is a duplex we bought back in June of 2021. We used 100% debt to finance the purchase price of $485,000, and we're currently under contract to sell this home for $560,000. Technically, our positive equity here is $75K, but this is where things start to get a little hairy. Although there's $75K of equity on this property, we'll be lucky to clear $15,000 in profit on this deal after the sale. The biggest reason we are losing all that equity is the amount of time it took to sell this property. We held this asset for way too long considering our business plan was to flip it immediately. Between taxes, interest, and insurance, our holding costs on this property are about $130 per day. We wanted to be in and out of this asset within 60 days, but it ultimately took us 6 months to offload it. That's an extra 120 days of carry that ended up costing us an additional $15,000 that we didn't underwrite to. After paying realtor fees, transfer taxes, and all the other hidden costs that come with buying and selling property, we'll be lucky to clear $15,000 in profit on this. That's about 20% of the equity that we currently have. We'd likely be much better off if we held onto this property and refinanced it into long-term fixed rate debt, but that was never a part of the business plan here. So we're going to take it on the chin and remember this lesson for our next wholesale opportunity. Which brings me to the next 2 properties that I just closed on. These are 2 properties that we acquired off market with the sole intention of immediately reselling. We bought Livingston for $445K and High Street for $410K. Our lender's appraisal for Livingston came back at $500K as is and $475K as is for High Street. We also got BPOs done on both by realtors, and the values came back even higher. Based on the comps, local realtors believe both properties can achieve $525K $125K as is. If we use the conservative appraisal values, we have about $120K of equity across both assets. It goes without saying we use 100% financing on both of these properties as well. After factoring all of the costs associated with buying and selling these properties, I'm looking forward to making just under 6 figures on these exits. The last property in my portfolio is my very first new construction project. I bought this property for $523,900 and the as-is appraisal came back at $575,000. Based on these two figures alone, I have $51,100 in equity on this property. However, I also have another $525,000 in construction financing on the back end of this deal. Once we're done constructing this house, I, as well as the appraisal, believe that it'll be worth $1.5 million. At that point, the equity position will be massive. $1.5 million ARV minus $524K in purchase price minus $525K in construction reserve minus $100K in carrying costs leaves us with roughly $350,000 in equity in that property alone, which brings my grand total of equity to $1,555.80. It sounds nice to be a millionaire on paper, but it's also really stressful. I have so much debt in my name. I'm not too worried about Champion, Walnut, or Scott Street because those are all cash flowing assets that have a debt service coverage ratio of 1.5 or higher on long-term fixed rate loans. Even in the worst economic conditions, these assets will continue to pay for themselves. Across those 3 properties, I have a little over $1 million in debt. However, the last 4 properties are all speculative in nature. The business plan for all of them is to buy low and sell high, and I finance 100% of the acquisition. The debt across those 4 properties is $2.49 million. At an average rate of 8%, it will cost me roughly $16,500 per month in interest only to service this debt. At the same time, I'm looking to offload 3 of those 4 properties in the next 45 to 60 days, so the stress will hopefully be short-lived and the risk will be well worth it. Time will tell. I hope you enjoyed watching this video as much as I enjoyed making it for you. As promised, here's a link to the video where I talk about my decision to sell my 3-family property. I thought it was a good idea at the time, but ultimately I changed my mind and decided to hold it as a long-term rental. Finally, I put out a new video like this every single week, so if you haven't already, please subscribe to the channel. I don't want you to miss the next one. All right, peace.